Understanding startup valuation, the heart of the matter, valuation. It's the buzzword in the startup world, but what does it really mean? In simple terms, startup valuation is like figuring out the worth of a business that's just starting out. Imagine trying to put a price tag on a delicious plate of samosas that haven't even been tasted yet. It's a mix of art and science, where investors try to estimate the potential of a young company. This valuation is crucial because it determines how much ownership founders give up in exchange for investment. It's like deciding how much of your samosa recipe you're willing to share for a bite of the investment pie. Why is it so important? Well, a fair valuation ensures both the entrepreneur and the investor get a good deal. It sets the stage for a successful partnership and future growth. Remember, a well-valued startup is more likely to attract the right investors and resources. Revenue, show me the money. Revenue is the lifeblood of any business, and for startups, it's a key indicator of traction. Investors want to see that your samosas are not just tasty, but people are willing to pay for them. The more revenue a startup generates, the higher its potential for growth and profitability. Think of it like this. A samosa stall selling 100 samosas a day is likely to be valued higher than one selling only 10. Why? Because higher sales translate to greater earning potential. Investors analyze revenue streams, growth rates, and the sustainability of the business model. A startup with consistent revenue growth is more attractive than one with fluctuating or stagnant sales. The founders, captains of the ship. A startup is only as good as the people behind it. Investors scrutinize the founding team's experience, expertise, and passion. They're like the chefs behind your samosa recipe. Their skill and dedication determine the final product. A team with a proven track record in the industry, strong leadership qualities, and a clear vision inspires confidence. They need to demonstrate their ability to navigate challenges, adapt to market changes, and execute their plans effectively. Just like a master chef knows the perfect blend of spices, experienced founders bring invaluable knowledge and networks to the table. They're more likely to steer the ship towards success, making investors feel more secure about their investment. Section 4. Market landscape riding the waves or battling the storm. Imagine launching a samosa business in a place where people have never even heard of samosas. That's the importance of market analysis. Investors assess the overall market size, competition, and potential for growth. A startup operating in a large and expanding market with limited competition has a higher chance of success. Conversely, venturing into a saturated market with established players can be challenging. External factors like economic conditions, government regulations, and technological advancements also play a significant role. A favorable market with supportive regulations can boost a startup's valuation, while economic downturns or unfavorable policies can negatively impact it. Section 5. The investor game demand and its influence. Investor demand is like the aroma of freshly fried samosas. It can make or break a startup. When multiple investors are interested in a company, it creates a competitive bidding process, driving up the valuation. Take the example of a new food delivery app. If several venture capitalists see its potential and are eager to invest, the startup's valuation will naturally rise as they compete to get a piece of the pie. On the other hand, if investors are hesitant or the market sentiment is down, even a promising startup might struggle to raise funds at a desirable valuation. Section 6. Pre- and post-money valuation, decoding the jargon. Now let's break down two important terms, pre-money and post-money valuation. Pre-money valuation is like estimating the worth of your samosa recipe before adding any new ingredients. It's the value of the company and investment round. Let's say your samosa startup is valued at 1 crore rupees before securing funding. This is your pre-money valuation. Now, an investor comes along and decides to invest 25 lakhs. The post-money valuation is the value of the company, the investment. In this case, it would be 1.25 crores, 1 crore plus 25 lakhs. Understanding these valuations is crucial for determining ownership stakes. If you raise 25 lakhs at a 1.25 crore post-money valuation, you're essentially giving up 20% of your company's equity. Remember, a high valuation isn't always a good thing. It can create pressure to meet unrealistic expectations and make future funding rounds more challenging. It's like pricing your samosas too high. People might be initially intrigued, but if they don't live up to the hype, they'll go elsewhere.